Okay, let's get started. I know people are still coming in, but I just want to, on behalf of CEBRA, the MIT Golub Center for Finance and Policy, and the Leibniz Institute for Financial Research's group on sustainable architecture for finance in Europe, I want to welcome everyone to these 2021 CEBRA annual meetings. I'm Deborah Lucas, a finance professor at MIT Sloan and the director of the MIT Golub Center for Finance and Policy. For those of you who aren't familiar with the Golub Center, I wanted to just say that it was created by senior members of MIT Sloan finance faculty, including Robert Merton, Andrew Lowe, and myself, with the mission of serving as a catalyst for research and educational initiatives that address the challenges facing governments, both in their role as financial institutions and as regulators of the financial system. With the evolving and increasingly prominent role of central banks in the economy and in the global financial system, and because of the very important work of the central bank research community that informs those policy choices, we were thrilled to have this opportunity to co-host this conference. We'd really hoped to be able to bring everyone together in Cambridge at MIT, but unfortunately that was still not possible this year. Still, I think you're going to agree that it's an excellent program, and I hope that since we're all quite accustomed to Zoom by now, that we'll be able to all make it a lively and interactive experience. While organizing and running a conference of this size and complexity is no easy task, I want to take the time up front to acknowledge and thank some of the people who have been working tirelessly over the last weeks and months to make this happen. That includes Victoria Mallinson from CEBRA, Daniela Dimitrova from SAFE, Paxton Kopp from Sloan AV, and most especially Deirdre Wade from the MIT Golub Center. I also want to thank Raphael Auer from BIS, who was the organizational lead at CEBRA, and Lorian Pelizon of SAFE and Athanasios Orphanides of MIT, who shared with me the scientific committee. And finally, all of the session organizers from central banks and others for contributing to this great program. Okay, good. So let's change gears and get started on our first high-level panel. I have the honor of having Carmen Reinhart from the World Bank, Refet Gürkaynak from Bilkent University, and Paul Tucker from the Harvard Kennedy School joining me to discuss the shifting boundaries between monetary and fiscal policy. So the way this is going to work is that each of our distinguished panelists is going to start with 10 minutes of opening remarks. Then I have some questions I want to ask them. And after that, if you all who are listening would like to submit your questions through the question function in Zoom, please do that. And I'll try to get to as many of the questions as I'm able to get to. I think we're also turning on the voting up, voting down feature. So if there's a question you like, you can vote on that. So let's kick it off with Carmen. You have 10 minutes.
Thank you, Deborah. It's a pleasure to be here. I'm speaking from storm-torn Florida, western coast of Florida, where we do have a low-scale hurricane going on. So let me begin, I guess, by saying, just putting a little very skeleton historical context. I think the question that Deborah posed, is on what defines monetary policy, what defines fiscal policy, and how liberal are we in interpreting this distinction. And let me start by putting a little historical context. I think, relatively speaking, monetary policy is comparatively young relative to fiscal. Fiscal has a much longer history. If you look at pre-fiat money, monetary discussions were non-existent, and government financed wars by shaving coins, literally shaving the value of coins. So the issues that we are grappling with in this discussion are really of comparatively modern vintage. Now, I think the next step when central banks came into being, many of them had very much a broadly defined a financial stability, not in the modern sense, but a financial stability focus also. And of course, during wars, asking the question of what is monetary and what is fiscal policy is a non-starter. Central banks, the role of central banks has been to finance wars. In the very modern context, I think what we're seeing is a renewed blurring between what I would call the heyday of independent central banking language and perhaps practices. And let me define again in that historical context the heyday of central bank independence. The advanced economies were left with a very large legacy of wartime debts at the end of World War II. And the central banks were there as institutions already. Ostensibly, these were independent institutions. But after the war, during the era of Bretton Woods, you had capital controls, you had very heavily regulated domestic financial markets, and we had a very different global financial environment vis-a-vis certainly the pre-World War I capital mobility, more liberal financial system. In that post-World War II era, central banks were very much walked toe to toe with the Treasury, with the finance side. In the United States, for example, in 1951, we had the Fed Treasury Accord, which ostensibly made more explicit the independence of the Federal Reserve. But even at many years after 1951 Fed Treasury Accord, the Federal Reserve also had an even keel policy, which also made sure that they didn't rock the boat around Treasury auctions and so on. What I am getting at is that this very crisp separation between central banks and treasuries is of comparatively modern vintage and really takes hold after the surge in inflation of the 1970s and the advanced economies. And, at that time, a very big man, figuratively and literally, Paul Volcker, joins the Fed and begins a disinflation process that raised real interest rates to historic highs and sets really the stage for the central banks embracing price stability and inflation as their overarching goal. It's very interesting that during that period in which central banks become this is not a politically correct term, but holier than thou, is also a time when instruments that the central banks use, the list of instruments gets shorter, okay? Because the question is about what separates central banks and the fisc. Well, what separates them, in my view, is the institutions they are and the tools that they use. Because in the end, a lot of what monetary policy does has real, that's the whole intent, very often has real consequences, has redistributive consequences. So the idea of a nice, clean separation between monetary and fiscal on the economic effects of the policy actions is, to me, much more difficult than separating the two by the institutions that conducts the policy and the instruments that are used. Now, let me go back to the instruments and to the height of the central bank independence. So I would observe that by the late 70s, early 80s, most of the legacy of World War II in the form of very high levels of debt had also pretty much come to terms with. So central banks really could raise interest rates with abandon without worrying too much about what it would do to the fisc or what it would do for financial stability relative to today, because households and firms were far less levered than they are today. This is so inflation stabilization, price stability, and the monetary policy instruments were narrowed. And this is, of course, in the advanced economies. In the emerging markets, central banks have retained much longer list of instruments. But in that heyday of central bank independence, the whole focus becomes on short-term interest rates as the key instrument. Things like reserve requirements, things like interest rate ceilings, other tools of financial repression, directed credit, and the like. All those things are set aside. We've come a long way from that again. The first step was the global financial crisis, and I wrote a great deal about financial repression. Maybe I can take up the issues explicitly of financial repression later on. But since 2008, 2009, the toolkit of the central banks began to expand, and in effect, beginning with the large-scale purchase of government securities, for example, that the Fed undertook. In the old days, that might have been called directed credit. So there is, definitely a resurgence of a richer list of tools and policies that begin to veer a little broader than just narrowly defined price stability, and the blurring with the fiscal. Notwithstanding the fact that it's, to everyone, I think, very clear that we're talking about separate institutions and very different set of tools, but that blurring occurs again. So I do view, indeed, things like inflation, financial repression, as a tax variety. But I will come to that later. I think I've had my allotted time. So let me stop here and hope that little tour was useful.
That was fantastic. Thank you. So let me turn it now over to Refet.
I'll do this right. It's a pleasure to be here, and it's a pleasure to follow after Carmen. Let me pick up where she left off. So it's, of course, all government policy, fiscal policy, monetary policy, it's all policy. But there's a reason why we have different labels for these things. And there's a reason why we have this panel now, right? In 2005, it would not have occurred to us to have a session on the blurring distinction between fiscal and monetary policy. Something is happening, very much like, there's a lot of work on monetary policy and pandemics. 3 years ago, no one would have thought of, let's do this. Wouldn't be a great hypothetical to think about, right? The world has changed, and it's based on what we are observing, that what central banks are doing looks less and less like the monetary policy of, let's say, the end of the 20th century, beginning of the 21st century monetary policy. And I think in itself, that is not a problem. Optimal policy is obviously framework contingent. As the world changes, what is optimal should and does change. And the question becomes, has the world changed in a way that makes this new observed mix of central bank behavior and fiscal policy behavior optimal? And that's not very obvious. Monetary policy has changed going back to the global financial crisis and its aftermath. And some of it is clearly because of the zero lower bound or the effective lower bound. The central bankers had to find other ways of stimulating aggregate demand. But this phrasing of the question actually rules out a lot of possible answers, in the sense that once you ask the question in terms of what is it that central banks can do to further stimulate demand once they have hit the zero lower bound, the object is the central bank. It still has to be the central bank that has to do the job. And that question, the answer to that question is a lot of the funkier processes from central banks that we have seen lately, what are collectively called unconventional monetary policy. But we could have also asked, what can we do, not limited to the central bank, to stimulate demand? And most reasonable economists would have said, well, you do fiscal policy. Now, that then becomes an important issue, whether we want to pick the policymaker responsible for this before asking how best to do it. How is the central bank going to do it, right? Every now and then, I have students come to me and say, I have blah, blah, blah questions, and this is the way they phrase it. How can you help me, right? And more often than not, the answer is, I can't. There's somebody else who can really help you, but that's not me. Now here, we couldn't go to that answer. And central banks actually, in a sense, rose to that challenge. And I think they performed admirably, given the constraints. But we have to ask the question, would it have been better if they said, we've done all we can do, we've lowered interest rates as low as it will go, and isn't this a great time to borrow and spend, and have done this a decade ago? That's an interesting question. And thinking about whether the world would be better if we had a different equilibrium in terms of who does what is an important question. Thinking about whether we can go there from here is a separate question. That is, if many advanced economy central bankers today said, well, we've done all we can do, and we're really tired, and we're really overburdened. So why doesn't somebody else do their jobs now, right? I'm not very certain that we're going to like the outcome of that. It will be a very painful period until somebody else actually gets their act together and does the job. So in one sense, things like central bank independence or monetary policy and fiscal policy separation, or the fear of monetization, monetizing the debt, right? These are not universal constants. These really are dependent on the world we're living in. And Carmen eloquently talked about war financing, where you don't worry about, am I giving the wrong incentive to the army? Is it really me who should be doing this? You do it first, and then think about how to pick up the pieces if you broke something. It really isn't like your unconditional love for your children. As things change, what you think is right, what you should be doing changes. It seems to me that perhaps with the exception of monetization, the world hasn't changed in a way that makes me say, yep, it's now a good time to give up on central bank independence. It's now a good time to think of central banks more as functionaries for fiscal policy. The reasons why that separation was there, the reason why we valued central bank independence, to me seems still to be there. Then again, the world has changed in ways that the challenges posed to policymakers are different. So, we weren't all that prepared for a global financial crisis and the zero lower bound binding. We weren't prepared for a global pandemic. And it wasn't very clear how to respond to these in the economic policy sphere either. I think the other thing that one can and probably should think in the same vein is climate change, how to think of the economics of this, how to best address that challenge. And central banks, since they had done especially in advanced economies, in most, except for Turkey, in most emerging markets too, they've done a very good job of controlling inflation and fulfilling their core mandate in most places. They were seen as competent policymakers. They had good research groups. They understood how the world is working. So there was both a public expectation that this competent authority would do something about the problem, whatever the problem is, and the central bank themselves perceived themselves as adults in the room, other policymakers not doing what they're supposed to do. There is some benefit here in making a distinction perhaps between what we think of as monetary policy and central bank policies. And by monetary policy, I would like to think of cyclical control. But a lot of other things central banks do, such as financial stability or targeted loans if they do it, or many other things, are clearly, since done by central bank, they're central bank policies, but wouldn't fall under the heading of monetary policy, the way we think of. And that enlarging that set of non-monetary central bank policies and affiliating them with monetary policy creates two types of problems. In fact, more than two. Let me quickly tell you 4 issues that come to my mind. One of them is the standard one that we're used to thinking of, which is it interferes with the core mandate. This, I think, is the least important now. I don't think, trying to fight against the economic fallout from the pandemic is interfering with any central banks, any advanced economy central banks in particular. Inflation targeting aim. In fact, these push in the same direction. So that's not a big deal, at least not now, right? But the other 3 are important. One is that the job usually isn't done right. The central banks aren't the best institutions to tackle these problems. To me, the best example of this is climate change. I have nothing against central bankers personally minding climate change. I have nothing against central banks as an institution saying, we should contribute our best to make sure that our building is not polluting. What we are doing is in line with the overall aim. But climate change primarily is not a problem that can be solved by any central bank tool. If you want this to be something to be addressed by central banks, you should let the central banks impose taxes. And in fact, this is the general thing in many spheres, that you want some targeted policy. And all of our public finance understanding tells us that, well, if this requires public policy, if it's taxation and subsidies, it is fiscal policy. Let the central bank then be the fiscal policymaker to allow carbon taxes to be imposed by central banks. Then central banks are good institutions to address this. But the job isn't done right. And if we actually care about the job, that's actually a bad way of doing things. The other bit is that the public doesn't really distinguish between the core mandate of the central bank and the core tools of the central bank and the rest. So if your central bank comes out and says, okay, here I am, and I'm going to save you from this mess as well, and you fail in doing so, people's perception of your central bank's competence declines. And it's not that, our central bank isn't good in doing this, and something that the central bank wasn't supposed to be very good at anyway. It's just that I have less faith in our central bank. And that's not a very good thing. The other one is a core point in this fiscal monetary distinction, which is some issues are rightly decided at a political level. And we don't want central bankers to decide, who wins, who loses, who is bailed out, who is hurt. Monetary policy in general does have distributional consequences, but these are side effects. A lot of what central banks do now are things that are directly targeted. And that targeting, I think, is one of the things that differentiates central banking and monetary policy from fiscal policy. And lastly, when you give a non-core mandate to the central bank that is not all that equipped to address, you're also saying somebody else who could have done this job, okay, you're absolved now. And that's in general a big problem. In the aftermath of the global financial crisis, this played out as central banks saying, okay, although interest rates are zero, we're going to do something to get us out of this mess. But that allowed the fiscal policymakers to further slacken at their jobs and say, yeah, okay, we're not going to cut taxes even further. We're not going to increase spending even further. This was a bigger problem in Europe. And that actually isn't just that the job isn't done right because the central bank is doing it, but because some other policymaker actually begins to do even worse policy. And the fallout from that oftentimes outweighs whatever benefit the central bank was able to bring to that problem. So these are the senses in which I think the separation of duties, it could be fiscal versus monetary policy, but it could be environmental policy versus monetary policy. The policy separation is an important problem because we have a lot of policymakers. And if you give the mandates randomly to the central bank, all these other policymakers with these other policy tools will do something. And we often will dislike what they are doing when they perceive themselves as not internalizing the outcome of that. Thank you.
Great. Thank you very much, Refet. And then finally, Paul, let's turn to you for your opening remarks. You're muted.
Yeah, thank you very much, Debbie, for including me in this. And it's great to be alongside Carmen and Refet, and hello to everybody that's watching. So political economy is back in a big way, and actually in a much more demanding way that I think has been reflected in the literature over the past 30 years. And I think the first half of Refet's remarks illustrated this. If you think about how a kind of modern about a problem, they think, well, what would the social planner do? What would be the optimal solution, and what rule might approximate robustly to that optimal policy, and then what institutional framework might substitute for a rule of some kind? But in the background is the idea that the social planner is benign, and if we flip to the political part of political economy, modern political theory, kind of meaning the last 200 to 300 years, in the West at least, has proceeded on the basis of, oh my goodness, the monarch, the prince, might be malign. What kind of institutional structure will help guard us against tyranny in the extreme, or misuses of power, which will be kind of horribly wasteful at best and oppressive at worst? And central bank independence actually fits into this. One of the cardinal principles of constitutionalism has been, well, we really don't want the king, the president, the prime minister to have the taxing powers on their own. We want them to have to go to the assembly, which is somehow representative of some part of society, in order to take resources from people. How does this link to central banking? So the printing press, of course, is a means of taxation. And I think one can think of, I would tell monetary history slightly differently from Carmen, even though I agree with everything that Carmen said. It's my overlay that's different. I think one can see the gold standard in a period before full franchise democracy as essentially underpinning the separation of powers, taking away from the prime minister or the president or the monarch the power to tax via money and ensuring that the president had to go to Congress or Parliament to get money. And in a world where the gold standard couldn't possibly work anymore for reasons I think it would be wasteful to discuss, I think independent central banks have been the modern solution to that problem. In other words, I think they're a corollary of the value of the separation of powers. And the period that Carmen was discussing, I think in an enlightening way, which is essentially the Fed from 1951 to the breakdown of Bretton Woods, is essentially a system where the separation of powers is not underpinned by a monetary constitution, as illustrated starkly by the meetings between Richard Nixon and Arthur Burns, who I think was a disgrace to his office. Now, why does this matter? Because the boundaries have shifted again and blurred in really quite peculiar ways. And I think that is partly a product of events, and it is partly inadequate regime design, and it is partly the incentives of the actors. And I'm going to say something about the incentives of the fiscal authorities, but I also want to say something about the incentives and dispositions of the central bankers, who seem to me, in an interesting way and in varying ways in different jurisdictions, to be more sensitive to political approval and newspaper popularity than I think one would want in an institution whose job is essentially to protect the parliament from the executive, and therefore to protect the people from the executive. And Carmen rightly remembered Paul Volcker. The idea that Paul Volcker could have achieved what Paul Volcker did if he had been sensitive to popularity during those years is of course completely laughable. And it is a great mistake, I think, to drift away from thinking of central banks and central bankers rather as a kind of reserve power, the people that are prepared to be unpopular to preserve something that is tremendously important. But I want to illustrate this with three things, and I will try to be quick, and you must cut me off, Debbie, as soon as I'm getting over the 10 minutes. First of all, kind of regular fiscal versus monetary policy. I don't want to repeat what Refet has said about this because I agree. I think one can think of it as a Stackelberg game. Essentially, the fiscal authority moves first, and their choice of move is not to move. And they have that option because they are under no obligation to pursue any objective whatsoever in law. And the central banker finds herself or himself there saying, oh, damn it, they didn't do what they could have done. We're going to have to do more up to the limits of respectable but creative reinterpretations of our power. So this is quite different from the results in the old fiscal monetary coordination literature. This is a world where there is always fiscal dominance in the context of a Stackelberg game, not the kind of fiscal dominance that we normally talk about in monetary economics. And therefore on that, and this of course has been costly. It's been costly in terms of exuberance in financial markets again, which may or may not reach a miserable end. And it has been costly in terms of fueling the opinion that central bankers are some kind of ramp for the wealthy by pushing up asset prices. So that's a first set of problems. And I think we can only solve that by thinking about the responsibilities and expectations of fiscal policymakers as well as monetary policymakers, although certainly that we should do from around at least 2016, possibly before, it was obvious that there needed to be a rethink about how the next recession, just an ordinary recession, would be addressed. And I thought the Fed review of that just kind of amounted to nothing much, actually. I'm not a kind of jihadist on discretion, but it's too easy to paint the Fed review as basically just taking more discretion to themselves. The second thing is kind of what is monetary policy? And Refet touched on this, but I want to put it in a particular way, which Steve Caccetti and I wrote about in a recent Vox EU piece. So let's take March 2020, where the central banks went out and bought loads of government bonds and said it was monetary policy. Well, if you think of monetary policy, regular monetary policy, as essentially being stimulating aggregate demand to keep aggregate spending in line with the path of aggregate supply so as to keep inflation in line with some kind of target and maintain the anchor, well, it can't possibly have been that because the economy was being closed down. So you don't want to stimulate spending as aggregate supply is falling. It could have been one of a number of other things. It could have been market maker of last resort so as to keep markets functioning. It could have been a covert rescue operation for parts of finance, particularly in the US and perhaps to some extent in the UK. It could have been steering credit as it became to different parts of the private sector, and it could have been emergency financing for government. But the point here is that when the central banker does something with their balance sheet, and I used to be responsible for one, it isn't monetary policy just because they say it is. And to get to a point where actually they are saying things are monetary policy when they kind of manifestly weren't, which at least one central bank has effectively admitted, is quite serious, but not something to become obsessed with. Instead, what we must do is develop regimes for market maker of last resort and these other things. And why should we do that? It's because they're independent, and therefore we need to be able to see that they are doing what they're saying what they're doing. They are doing what they say they're doing, and we know how to assess whether or not they're having success or not. And then finally, thirdly, Pigouvian taxes, which is where climate change fits in. And I'm very concerned about this. I'm concerned about the particular kind of, if you like, sociological, political context which has drawn central bankers into this. But I'm not going to dwell on that. And let me say in advance, I'm in favor of a carbon tax. And I think that anti-climate change policies have been very weak in governments as a whole. But here are problems with central bankers. So the ECB have embraced this. So if Christine does various things and the climate campaigners think she hasn't done enough, and other people think that she's done too much, how is she going to warrant her being the referee for how much should be done? That's the first thing. Secondly, if the justification for the central banks getting involved is that climate change will be bad for financial stability, which most certainly it would be. Of course, wars are bad for financial stability, and civil wars are bad for financial stability. Should therefore the central bank ration the supply of credit to arms manufacturers and to arms dealers of various kinds? And then thirdly, and this plays right into politics, and I have the United States in mind. I'm going to give a United States example, but one could create other examples for other places. Climate change is obviously existential. So is abortion. And the thing about politics, democratic politics, is that one's own side won't be in power forever. If it is the right thing to ration the supply of credit to polluters of climate change, which actually I wish governments would, but I'm uneasy with central banks doing, what chance is that down the road, when a certain brand of conservatism, not mainstream Republican conservatism, but a certain brand of conservatism has all 3 points of the American triangle, that actually there will be pressure on the Fed to introduce regulations and collateral policies that ration the supply of credit to Planned Parenthood and to the suppliers of Planned Parenthood. And anyone that thinks these things are fanciful has not actually been a senior central banker dealing with politicians in times of political need. This is how politicians think. What can I get other people to do that it would be awkward for me to do, but I want done? And so I think that this is part of a broader malaise where we are drifting to a world where, in US terms, there is a risk of being ruled by the Supreme Court and the Federal Reserve. And really it's to do with the passivity of our elected representatives. And this goes back to the way that Refet and Carmen framed it. And because of course it is much more difficult than I'm making it sound. And it is back to the Staffelberg game, but on a grand scale. If you are a top central banker and the elected government does decline to act on all sorts of things, existential climate change, recovering the economy, and they're plainly not going to move. And yet you can do things because you have a balance sheet, which enables you actually to reinvent yourself as the government, because you'd effectively write options with every household in the United States or UK or continental Europe. Then you become the government because the government has declined to govern. And somehow, but it would take a longer conversation and probably not this one, somehow the interesting thing for historians will be, how did central bankers allow themselves, if you like, to be overstating it somewhat, to be tricked into this game? Because for the game theorists of central banking, what has happened is that the people in politics, they have decoded the game of central bank independence. And that is a really, really interesting thing. And perhaps it was always inevitable.
Thank you very much, Paul. So I think there's very much substantial agreement between all of you that there isn't a clear line, that it's fuzzy, that it's always been fuzzy. And I guess I want to give you the opportunity to be a little bit more specific on some of the things that are actually going on. I think this will also be an opportunity for Carmen to come back to financial suppression. But I hope that each of you can give an example of a policy that you believe lies on the fiscal side of that boundary, that's become common practice in central banking that perhaps goes too far, or perhaps you think that it's beneficial and it hasn't gone too far. But I wonder if each of you could say a few words on that, and let's just continue in our original order. And let me first throw that out to Carmen.
So, much already has been said on, as you summarize, on the fact that it is perhaps easier to separate, and even then, conceptually, it's easier to separate than certainly in practice. I want to go back to address your question. I want to go back to the incentives issue that Paul raised. And you're asking for an example of a policy that's been done. I'll certainly talk about financial repression, but the issue is not financial repression itself, it's the incentives that creates for households, businesses, and governments. First, let me define the issue, and then you can, the term financial repression has usually been applied to talk about, developing countries that have, high inflation rates and capital controls and negative ex post real interest rates, and that the central bank, the monetary authority, has a really big footprint in the financial market. They control things, they run things. Well, if you go back, there's nothing intrinsic about financial repression that, was adopted in varying degrees in the advanced economies at the end of the war. And, I've argued for years now that we have seen a resurgence of it after the global financial crisis, because what are the pillars of financial repression? Financial repression means that, relative to the private actors, the central bank has a really much larger footprint on financial markets and setting prices. Number two, it is usually associated with more intense financial regulation. And notably in that regard, regulatory policies that increase the size of the captive audience for government debt, i.e. financial institutions, pension funds, and so on, being encouraged or actually asked to hold more government debt. And number three, the whole upshot of financial repression is through to deliver negative or negative real interest rates, or certainly lower than what the market would have delivered. The third point is the end point that I want to talk about, the issue that you raised on incentives. I mean, on what policy and Paul's point on incentives. Negative, the financial repression tax, negative real interest rates are a transfer from savers to borrowers. And that's nothing new. And sometimes, that's a trade-off that depending on, output gaps, inflation relative to targets and so on, may be quite appropriate temporarily. And I use the term temporarily is, I think what has shifted post 2008 and intensified now after COVID is the issue of almost one-way bets that and this also goes to an issue that Paul raised on central bankers being more perhaps influenced by popular opinion, how they're portrayed in the press, how friendly they're seen, how politically correct and all those things that makes them much more perhaps contemplate with much more hesitancy doing very difficult things. I'm not saying that a rate hike is called for now. But this is not what I am saying is that an asymmetry to me has been introduced, that there is a bias. You can always lower interest rates. You can always accommodate more. But I think the expectation that this is skewed, that the distribution is not symmetric is something that I think we are seeing in the incentives it's produced. I'll conclude by saying that those incentives have also financial stability consequences. The idea that rates are low for long, low forever, or maybe low, but with only interrupted by modest upside corrections, really there's during particularly 2020 at the height of the initial shock of the pandemic, there was such a disconnect between financial markets and booming equity markets and collapsing economies globally. And also, the willingness of corporates to take on, high risk corporates taking on a lot of debt. So what I am going about in a roundabout way is that financial repression, or more broadly define any kind of policy combination that delivers negative ex post real interest rates or lower than what the market would have prevailed for indefinite periods of times, and it grinds those expectations will plant incentives that I think are a source of concern in terms of what it implies for risk-taking, indebtedness, and just this general disconnect often that we see between real economic activity and asset prices. So let me stop there.
Thanks. Refet, let me give you a shot at the question.
Thank you. Let me begin by saying how much I enjoy being here, and it really is wonderful to be part of this. The Steckelberg game Paul so eloquently described, Troy Davig and I wrote up that game and solved it at the International Journal of Central Banking in 2015. and the equilibrium is as ugly as he mentions. Now, I guess what defines things that central banks do that aren't quite monetary policy or more likely to be fiscal policy isn't what it is that the central bank is doing, but why it is that they are doing this. So when I see a central bank lowering interest rates because there's a recession, I look at this and see monetary policy. When I see a central bank lowering interest rates because the treasury has to borrow and they find it difficult to borrow at the ongoing interest rates, I see fiscal repression. And it's not always very easy to distinguish these two. But it is the case that sometimes we look at things and say, it's really difficult to be convinced that this is being done for standard cyclical reasons. The US QE, for example, to me is monetary policy. When you hit the zero lower bound and you're buying treasuries, and it's a treasury that isn't looking to borrow more, especially in the immediate aftermath of the global financial crisis, where I would have liked the treasury to actually go crazy on borrowing, but they were refusing to do so, and the Fed was buying all kinds of treasuries. The aim there really was kind of Hail Mary, let's just dump a ton of liquidity and hope that it's going to do something, and that's still monetary policy. But something similar looking in the euro area wasn't all that much monetary policy to me, because it really was, the desire was more targeted, helping the peripheral economies, helping the economies that were not doing all that well in terms of their borrowing costs. And you can see it in the market reaction too. So there I look at this and see that, this is something done by the central bank. It looks like what the Fed is doing, but I see more of a fiscal policy here, more of a distributional aim in this one than what I see in the US. More currently in the US, for example, the Fed buying firms bonds in the secondary market, in the primary market. I look at that and see this really is targeted, and it's not the overall macroeconomic stability, right? It's these firms being targeted, and it's difficult for me to see monetary policy in the honest to God old-fashioned monetary policy that I'm used to in that. It's not that I'm against helping firms, but and Paul spoke about this. This should not be a central banker's call that we decided that these firms ought to be helped, and here's how we are helping them. This really is a political decision and has to be done by the right people in the right ways. So I think that's the sense in which I think of monetary policy versus fiscal policy distinction when done by central banks. It's really what is the thinking behind this? What is the aim of this policy is a better metric to understand whether I want to think of this as standard monetary policy versus, or non-standard monetary policy versus more of fiscal policy. It really is the aim and why they are doing this rather than what is being done. Thank you.
Good. Okay, and Paul, do you have any specific policies you want to bring to light?
Yes, let me just say first of all very quickly, because I think it's probably an international audience, that my approach to this is very much dependent upon local constitutional traditions. So when I talk about things like the importance of the separation of powers, that obviously wouldn't apply to the PRC. And the reason this matters is that one's really talking about the division of labor between, in democracies, elected power holders and unelected power holders in controlling the state's consolidated balance sheet for what purposes. And if you don't have a division between elected power and unelected power, then the debate has to be reframed somewhat. And the reason I think that matters is because I think it's been a conceit of the technocratic elite, my tribe, to frame the debates about central banking, particularly in the Basel Tower, where I was a director of the BIS, as though is one set of answers for everybody, irrespective of their constitutional traditions and circumstances. But you want an example, and I'm going to give an example for constitutional democracies. It's discretionary choice over steering credit towards or away from particular borrowers, sectors, regions. And the reason this matters is that, we're having a meeting and we decide to cut off the supply of credit to some set of firms that is polluting. It needn't be a climate change. It can just be kind of polluting in the kind of generic sense. And they go out of business. They actually can't adapt, and the pollution ceases, and that's a good thing. Except it turns out they were the main employer in their locality, and their locality goes into some kind of recession. Through hysteretic costs, it becomes quite a depressed region for maybe a quarter of a century or more. And who the hell were the unelected people? What were unelected people doing deciding that? I mean, not all policy trade-offs are for people like my successors. And the part of the point of democracy in democracies is precisely so that we can elect representatives to make these choices about who wins and loses and what is done to support the losers. And that, of course, isn't unique to democracy, but it takes a particular complexion in democracy. And have they been doing this? Yes. And is it amenable to political pressure? Yes. I can remember one instance, it wasn't quite credit, where we late at night were having to make a decision. And it turned out that what in London is called the other end of town objected to one significant detail in what we were doing, really objected to it. And later on, it turned out that this was to do with the some businesses located in the district of a very important politician. I mean, later that night, it turned out that. I mean, and actually, I have no criticism of the politicians in this respect. That's what politics is. But you have to design the regime in ways that are proof against that. And those, I think one of the things we must quit doing is taking reassurance from central bankers that say there's no need for you to worry about our independence, because one wants to take their reassurance, because one wants it to be true. But they are the last people who can reassure us, because of course they would say that. So you just have to design the regimes in the way that we can reach our own, well, not just us, but the people out there can reach our own views. And this matters beyond reasons of the optimality of policy over a year or so.
Great. Well, we only have a few minutes left, and I would love to ask you a lot more questions, but I'm actually going to take an interesting question that came in from the audience from Kosovo. Most of our discussion has been about developed countries, but very little has been said about the more constrained central banks in the developing world. And the question, I'll paraphrase it by saying that when there's a crisis like the pandemic in a developing country, basically all the central bank can do is come in and print money, and which is clearly kind of fiscal. But what do you all think about that? Well, I shouldn't say all, so I would say a few of you can grab the question, but we're almost out of time. So who would like to comment on printing money in the developing world? Carmen.
So let me just say, I really the first time that I am aware of that many emerging markets collectively were able to do counter-cyclical monetary policy was during the pandemic. This is really big. Typically in bad times, what has been the EM central bank response is to try to build up confidence. You raise interest rates to avoid currency crashes, to curtail inflationary expectations and avoid capital flight and so on, or limit. This is the first time we see counter-cyclical monetary policy. I think it's been quite, I think, useful, given that emerging markets have much more limited fiscal space, and that indeed, the ability to do fiscal transfers and any kind of fiscal stimulus was certainly much more limited. Now, I think emerging market central banks are in a very difficult position right now because and it is a trade-off between the two central bank objectives. One is the output gap, and the other one is inflation. The output gap is still high, and it is likely to be persistent. At the same time, inflationary pressures have been rising. However, the one thing I do want to highlight that is, I think, very much in the spirit, Deborah, of the questions you've been posing. The inflation tax is a very regressive tax. And what we're also seeing in many emerging markets is a spike in inflation is usually accompanied by a big relative price change, meaning a relative price change in the relative price of food. The two things have traveled hand in hand. So higher inflation is not just higher inflation and a higher inflation tax, but also has typically affected relative prices. So it is quite understandable that, to me, that many emerging market central banks at this conjuncture are already raising interest rates. Even though on the surface you would say, well, you're still far from the recovery, you're still far from full employment. But I think that trade-off facing, especially, the big distributional effects of rising inflation. And lastly, the big effects also of the possibility of unhinging inflation expectations are two EM preoccupations at loom large.
Can I say something very quickly about that last point, Debbie? Always have an exit route, and your exit route must be constrained in part by maintaining anchored medium-term and long-term inflation expectations. And this is now afflicting everybody. I mean, broadening it beyond emerging economies, there is a great deal of difference between saying, I'm going to run the economy hot and see what happens, from subject to maintaining anchored medium-term, long-term inflation expectations, I'm going to run the economy hot to help recovery. Those are profoundly different things. And almost no one bothers to say the conditioning clause anymore, which is a profound change. And that applies to emerging market economies and actually developing economies as much as it does to kind of rich and flailing about economies. Sorry, Refet, cut in with that.
Happy to. Agreeing with both, I'd like to point out that a key question here is whether the emerging markets in question has a current account deficit or a surplus, or a net asset position that is in deficit or surplus, right? Because the bigger problem for many of these countries is what they really need is dollars, and they are unable to create that. And in fact, their populations are so attuned to policy actions in this regard that should they try to monetize, their currency is going to depreciate faster than monetization is going to help them, and they're going to be net badly hurt. And that seems to be an important concern that has to be kept in mind. So emerging market countries that actually just need money of any kind are not all that different from advanced economies. They may face higher inflation, but they are able to create seigniorage. But if what you need really is the real resources to buy foreign currency, then usually in a much deeper hole.
Well, very good. So I want to thank all of you for really great discussion and points. And our time is up. The next session is starting at 9:10. So thanks again, and see you later.
Thank you. Thanks everyone for listening.
Thank you very much.